Thank you, everybody, for joining us. My name's Rob Beatty. I'm a part of the team here at C.O.R.E. I am part of the case design team, particularly in the advanced planning scenarios, of which business continuation planning is what I consider advanced planning. I also consider it one of the pillars of risk management planning. For a lot of our high net worth clients, their wealth is derived from their businesses. They're entrepreneurs, small business owners, family businesses, multi-generational businesses, privately held business interests. And business continuation planning is a very critical part for the owners' long-term financial security, for their families' long-term financial security, for their co-owners, partners' financial security, and for the employees' long-term financial security. So today we will be discussing the strategies for business continuation planning. So our overview is one, what's the need? Talk about, what is a buy-sell agreement? What are the steps to the process? Valuing your business, talking about the failure to plan and what those outcomes may be. How do you fund the buy-sell agreement? What are the different types of buy-sell options that are typically available? Also address key person, because key people in a business that may not be owners are critical to the long-term success of the business. Non-qualified executive compensation plans, golden handcuffs, and then addressing IRC section 101J, which is absolutely critical to the tax treatment of any type of insurance planning for business continuation. And the other thing I'd like to say, today, the purpose of today's call is to give you a broad understanding of the components. If your objective today is to walk away from this call and to be an expert in business continuation planning, that's not going to happen on this call. It's to, one, identify what the issues are, two, identify the resources needed to solve the problems. And yes, it's a commercial for us, C.O.R.E, as insurance distributors, to highlight where we can be of service to you and your clients in providing these solutions. What's the need? It all comes down to one important question for the business owner client. When the time comes, and it's when, not if, whether through retirement, disability, or passing, who will continue the legacy of your business? If the proverbial bus comes down the pike tomorrow, for whatever reason, whether it's, death, disability, retirement, or I'm just done and I want out, what would you like to have happen to your business? What's your ideal wish that when you're done and you wish to exit, or you and your partners wish to exit, what would you like to have happen? So fundamentally, in all business continuation planning, you have to have some type of an agreement. In absence of an agreement, it's a he says, she says, and in many cases, depending on the value of the business, the size of the business, it's my lawyer and your lawyer battling it out as to what happens in the event that a business owner wants to exit the business for whatever reason, or they're the sole owner of the business and they want to exit and they want to pass it on to whomever to continue the business or sell the business. A buy-sell agreement is a legally binding contract between co-owners of a business, which governs what happens to their ownership interest in the event of death, disability, retirement, or some other triggering events, such as divorce. A buy-sell agreement helps to protect the continuation of the business with little interruption from employees, customers, and creditors. Absolutely critical. Protect the financial security of the owner and their heirs in the event of death, disability, or retirement. Establish a method for valuing the business and identifying the purchasers of the business interest, so that it's all predetermined up front. In the event that something happens to the business owners, what's going to transpire. It makes for a smooth transition. And again, as it says, as I just said, it's about the employees, it's about the customers, it's about your business relationships, your vendors, your creditors, everyone. If you have a plan in place, when the unexpected happens, it makes for a smooth, orderly transition. What are the steps? And again, the steps are relatively simple. The primary thing is the one determine the value of your business. So many of our high net worth clients are business owners, entrepreneurs, own their own business, and that business is a substantial portion of their overall net worth or their overall estate. And so if someone comes to us and says, hey, we want to put a buy-sell agreement in place, or sometimes where it starts is, hey, I've got this client and they want to do an estate plan, and the biggest asset in the whole balance sheet for that client is their closely held business. We can't do any type of planning, whether it's the buy-sell planning, the estate planning, the transition to the next generation planning, until we know the value of the business. Anything you do without knowing that valuation is pure academic. It's just, it's, nice mind exercise, but if you don't have a value for your business, it's meaningless. So business valuation, absolutely critical first step. Then you need to decide on a source of funding. You've established the value of the business. You've established that you want to have a business continuation plan in place. Then you got to figure, okay, if I put a business continuation plan in place, it usually involves somebody buying something, somebody gifting something, somebody transferring their interest in the business. You got to figure out a source of funding for that transition. And then you need to select a plan type, whether it's a cross purchase, a redemption plan, a wait and see plan, an ESOP exit strategy. You need to decide what's the legal structure look like. And then step 4, it's all academic until we implement the plan. So then, okay, we've got the valuation, we've got how we're going to fund for the transition, we're going to determine the plan type, and now we need to pull the trigger and execute it. And that implementation is going to involve the client's financial advisors, who's going to act as a quarterback on the team. It's going to involve their accountants and their CPAs, maybe their auditors, and it's going to involve a legal team to make sure all the legal documents match up with what the client's stated wishes are. So what's the importance of valuing your business? One is estate planning. As I said, typically in the cases that we work with, the business asset is the largest single asset on somebody's balance sheet with regards to what their net worth is. So a business valuation meeting certain requirements may establish the value of the business interest for estate tax purposes. The IRS has 17 generally accepted standards for valuing a business. And of course, when you're trying to sell your business, you're trying to maximize the value of your business. And if you're trying to determine the value of a business to pay estate taxes to the government, you're trying to minimize the value of the business. The IRS has what they deem safe harbor rules that say, okay, if you've done this and you've done it this way, we'll accept that as the valuation for estate tax purposes. So it's also important to know the value of business interest to determine whether the deceased owner's estate might be eligible for certain potential tax relief provisions. There's a 6166 election that's available, and it goes to the heart of the issue of if your business interest, your closely held business interest is 60 or 70% of the value of your estate or 50% of the value of your estate, and you meet the criteria for a 6166 election, it allows the executor of the estate to stretch the estate tax liability payments out over 10 years or 14 years, actually. So it allows that to be spread out. Now, in absence of any other potential solution, it's a good election, but there's more efficient ways to deal with the issue. But it does allow you to spread out the tax liability over time. And it's at interest, though. I mean, it's not an interest-free loan from the IRS, but it also allows it so that the business or the person's estate isn't crushed from a cash flow perspective to pay a large estate tax as a lump sum. It allows them to spread it out over time. So business continuation, a full and fair price can be determined for the business interest to be sold upon the owner's death, disability, or retirement. Business valuation is an essential component in establishing a buy-sell agreement. It is also important if you're going to gift your business. And there's an interesting, and I found out the hard way many years ago. I was working on a business transition plan, and the owner wanted to pass the business on to their key person employee. And ignorant me said, well, he can just gift the interest to the employee. And the attorney came back and said, you can't do that. There's a section in the code that says you cannot make gifts to employees. And I learned that lesson the hard way. but you can't, but you could gift it to your children or your grandchildren, heirs, or anybody that's not an employee of the business. You could gift interest in the business. And it also goes toward creditor relationships. If you're going to go for a loan, a business line of credit, or a loan to, build a new plant or to expand a new business opportunity, well, your creditors are going to know what the business is worth. They're not going to loan you $10 million because you just eyeball it with your thumb and say, yeah, it's worth 10 million. They're going to want a formal business valuation to determine whether or not the credit risk is worth it to them. And the business valuation and the structure of the business is going to matter. It's going to determine even if they're going to loan you the money at what rate, right? Like how profitable are you? Is it cash cow? Is it asset intensive? All those things will affect it. But the business valuation is critical to all of these things. And I would like to say we have resources. If you can provide us 3 years tax returns, we can get an informal business valuation done, typically within 5 to 7 business days of you sending us the tax returns, and we complete a simple 1.5 page fact finder. We can turn it around and get you an informal business valuation. We have to say informal because it's informal. It doesn't have, a signature on it from somebody that's a certified business valuation auditor. But I will tell you the process that we go through. The end result's going to be within single digit percentage points, low single digit percentage points of the same formal valuation that you might pay $15,000 or $20,000 for. It's a resource that we have. We use it because we can't do what we're going to do to assist you without that valuation. I mean, we can, but again, we can set a structure up, but what we can't determine is how to fund it or fund it at what level. So one of the things we can bring to the table to help is business valuations. And there's no charge for it, by the way. It's a free service that we have through resources that we have available to us. So failure to plan, planning to fail. You've all heard it. It's a cliche. In absence of a plan, it'll be chaos, right? It's going to be people scrambling. It's going to be all kinds of issues that should the key person, something happen to them, what's going to happen to the business? And if no one's talked about it, there's no plan in place, there's no legal plan in place, which is absolutely critical. Even if you have a key person and you say, hey, if something happens to me, I want you to be able to run the business, they can't just walk down to the bank and say, Bill told me he wanted me to continue on with the business. Can you let me into the bank accounts? They'll just laugh at you and ask you to leave. So without proper advanced planning, the disability or death of a business owner can result in many costly consequences. One, sale of the business or business assets at a fire sale. If your family's dependent on the revenue from that business to sustain their lifestyle and they don't have the ability to step in and run that business, they're going to look to sell the business as fast as possible. And there are people out there, value investors. They are waiting for the fire sale. They know people are in a desperate situation. They're going to use it against them to get a heavy discount if they're going to buy that business. The loss of a primary source of income for the disabled or deceased owner's family. I mean, if you're the owner and the key person and you're taking home all the income and something happens to you, the income stops. You also, many times the covenants in the small business loans has, if something happens, if the person who is signing that loan on behalf of the business should exit for whatever reason, they can call the loan, right? If you're negotiating sale of the business or transition of the business, the creditors want to know who's going to be involved. And many of those loans have covenants. I'm not saying they exercise them every time, but the bank can call the loans. And then the possible need to liquidate estate assets to pay business debts or to pay estate taxes. If the business is leveraged, the family may have to say, well, assets that they took out of the business and built wealth independent of the business, some of that may be needed to pay back the liabilities of the business or to pay the estate taxes to the IRS. So again, all of this can be avoided with a sound business plan. Funding the buy-sell. I'll get to that when we talk about buy-sell agreements, but borrowing the money, you can go out and say, okay, somebody say, hey, someone needs to be bought out. The key person passes or the business owner passes and people want to that you put the buy-sell agreement in place, and the people that are going to remain and continue to run it, well, they go out to a third-party bank and borrow the money, right? And then buy the interest out of the deceased or the exiting partner's estate. You can invest money in a side fund or a sinking fund where the business is setting aside money, on an annual basis. They're putting money aside into a sinking fund. I'm going to tell you that's one of the least efficient uses of corporate assets that I can think of. It's just having it sit there in a side fund as a contingency for some unknown future date. It's Most CFOs would have a heart attack about that. You can do an installment sale where the the remaining partners, the remaining employees are going to buy out the exiting partner or shareholder. They put a percentage down and then they finance the balance over time, paying that note off out of after-tax cash flow generated by the business or by the interests of the remaining shareholders. Life insurance, this is, why do people like me talk about this? Well, life insurance is the most tax or most cost efficient way to fund this liability. For pennies on the dollar, you can generate a large pool of income tax-free money to either the business or to the remaining business owners to buy out the exiting shareholder. And then, of course, there's an employee stock ownership plan. Now, I'm going to tell you that's not a very good business transition if an immediate event happens, such as death or disability. It is a great long-term exit strategy, built-in overtime exit strategy for business owners. We have a whole presentation just on ESOPs. It is a tremendous tax efficient way for business owners to exit the business. And they can do it without giving up complete control of the business. They can maintain a controlling interest, but set it up so that in the event that one of these trigger events happen and the ESOP's already in place and it's already properly structured and funded, then if one of those immediate events happen, such as death, disability, retirement, then the structure's in place. So ESOPs are a great strategy. If you have interest in it, we have a presentation on it. That presentation is also posted to our YouTube channel. Common buy-sell plan options. There's a cross-purchase agreement, there's an entity purchase agreement, and there's a wait-and-see agreement. The cross-purchase agreement is the individual business owners are the ones that are going to buy the interest out of the exiting shareholder slash partner in the business. So that if one of the shareholders in the business should pass, the other shareholders say, we personally are going to go in, we're going to buy your interest and we're going to take over ownership of it and buy your family out. Your family has a liquidity event. We now own a larger portion of the business. An entity, and there's pluses and minuses to all of these. The entity purchase agreement is that the business itself is the party that's going to buy out any of the deceased or disabled or retiring business owners. So the entity buys out the interest of the departing shareholder. And then there's a wait and see agreement. It's a tiered agreement. It starts off you could start off as a cross purchase agreement, and then it's an option where the shareholders have. I'm sorry, it's where the first tier is the business. You treat it as a redemption agreement where the business has the option to buy out the deceased. Then the second tier is that the owners get to buy them out in a cross purchase arrangement. They have the option. And if they fail to exercise that option, then the business in the third tier is compelled legally to buy out the deceased shareholder. It's the most flexible arrangement. Now, with all of these, I'm going to tell you, because of the Connolly ruling, which came down a few years ago from the Supreme Court with regards to business valuations with an entity purchase, where we rarely recommend entity purchase agreements anymore unless none of the other options are viable for whatever reason. And the reason is that so it used to be that if I had a business worth $10 million and partner A owns 5 million and partner B owns 5 million, and they put a redemption plan that if partner A should pass, the business is going to buy partner A's $5 million interest back into the business, and now partner B remains and owns $10 million. And so you buy insurance, and the business buys insurance on each key person. So it used to be that the partner A dies, the $5 million death benefit comes into the corp. And it used to be that the buy-sell agreement was an offsetting liability that zeroed out the $5 million infusion into the business. Now the Supreme Court says no, the business is worth 15 million because it just got a $5 million infusion from the death benefit. So now you have a buy-sell arrangement in place. The remaining shareholder, partner B, is now got to buy out partner A for $7.5 million. They've only got 5 million of death benefit. They're going to have to carry a note for the other 2.5 million. And the deceased shareholder A's family and estate have to bring the business and value it on their 790 estate tax form. They're going to have to value it at $7.5 million, which, given where we are with estate tax limitations, it may or may not matter, but it could push them over that limit where they owe estate taxes on that additional 2.5 million. I think it's bad accounting on the Supreme Court's part. It really doesn't matter what I think. That's the rule. So wherever possible, we want to avoid that situation. Have a cross purchase agreement in place. Because the other advantage is that when you do a redemption agreement, there's no step up in basis. So partner B, the company's worth 10 million. Partner, if there's a redemption, and let's say their cost basis, each cost basis is $1 million. So they have $4 million of gain each. In a redemption, now shareholder B, their valuation is $10 million, but their cost basis is still $1 million. In a cross purchase arrangement, if partner B buys out partner A, they've got their $1 million of basis and they get a $5 million step up in basis because that's their purchase price, right? At that time, at the partner A's death, now their cost basis in a $10 million business is $6 million. So that should they go to sell it down the road, it minimizes how much capital gains that they're going to have to pay versus a redemption plan. So generally speaking, right now, we're doing cross purchase agreements, or I prefer the wait and see agreement because it's got options. Because let's just say for whatever reason, the business outran the plan and they didn't have time to amend it, or whatever it may be, that it makes more sense to take the hit and do the redemption. Right, so you do the wait and see. It's a tiered where you have option, and then the business is compelled to execute the buy sell. So this is just a graphic. So owner A, owner B, I got them backwards, who was staying and who was remaining. They buy insurance on each other. They have an agreement in place to buy each other out in the event that there's a triggering event. You get a step up in basis on the purchase. It's a pretty clean, simple arrangement. The business really isn't involved. So then people say, well, how do we, let's say, owner A is 40 and owner B is 50, and you're trying to buy insurance to fund it, and owner A's got to pay higher premiums than owner B. You can work that all out via bonuses and compensation. That can be worked out on the, doing the accounting on the P&L. How a redemption entity purchase, the business buys the insurance. The business is the entity that's buying out the departing shareholder. Again, there's some negative tax consequences to it. So why do people in the past, because prior to the Connolly ruling, you'd say, okay, you're still better off with a cross purchase because of the step up in basis when you do the buyout. Let's say, it's not 2 partners. Let's say we have 6 partners. So if you're doing a cross purchase arrangement now, and there's 30 some policies flying around back and forth. It's difficult to administer. It can be done. It can be simplified. But the easy button for a lot of people is, well, instead of buying, each partner buying 5 policies on the other shareholders, right? Having 30 policies, you just have 6 and the business does it. The business pays it. But business pays the premium after tax dollars. It's just a lot simpler. It was the easy button. For me, with 4 partners or less, the cross purchase even then made sense from a complexity. It's not that complex. But when you start getting multiple people, there's just a lot of parts flying, right? So people would go say, hey, let's do a redemption, keep it simple. But you sacrifice step up in basis. And then the wait and see agreement, again, there's just options. It's a tiered option. And you know what, in any type of planning, the greater the flexibility that you have built into the plan, the better. It's better to have options than to only have one path to the solution. So one of the things I want to say, what we also can do, if your clients already have a buy-sell agreement, if that thing's more than 5 years old, even 3 years old, it needs to be reviewed. So another resource we have available to us is that if you send us your client's existing buy-sell arrangement, we will do an audit on that arrangement, come back, give them a summary of what they have. Because several common things that we catch when we do the buy-sell agreement audit. One is they have it set up as a redemption, but they funded the exit strategy as a cross purchase or vice versa, right? Well, we bought insurance in each other, and I own one on Bill, and Bill owns one on me, and we got to make and everything's he's beneficiary of the policy he owns on me. I'm beneficiary of the policy he owns on him, but it's a redemption plan. Needs to be fixed. The other thing is that if day one today, if you have a business that's a growing business, to day one today, we put a valuation in place and we structure the buy-sell agreement. We go out and we buy insurance to cover 100% of the buy-sell arrangement day one. If the business is growing, even at 5 or 10% a year, 5 years from now, the amount of insurance that was purchased was inadequate. Now, you can buy more insurance if they're insurable, sure, but typically we can't, we don't know the timing. So there's a possibility that the insurance is only going to cover a portion of what the liability is to buy out the exiting partner. So the rest of it's got to be financed. So one of the things I see is that the terms of that finance, that buyout. I see stuff like, well, it's a 5-year buyout and it's based on prime plus one, 20% down, finance 80%, or whatever the outstanding balance that the insurance doesn't provide cash flow. So you've got this short-term note. Well, that note, regardless of whether it's me buying out the other partner or the business buying out the other partner, has got to be paid with after-tax dollars. And let's say in my scenario, you have a $10 million business. We bought 2.5 million of insurance and we owe another 2.5 million because the business grew. And I've got to pay that back in 5 years at prime plus one. Well, just do that amortization. It's got to be done with after-tax dollars. Only the interest component of the note's deductible. It can crush the cash flow of the business, right? Just think, you take 2.5 million, amortize it over 5 years at prime plus one. What type of cash flow is that? You take that out of the business, combined with the fact that one of the key people is no longer in the business. It can really crush the business and eliminate the long-term viability of that business or substantially curtail it for the 5 years it takes. So some of the things we like to do is, hey, it's a double-edged sword. It cuts both ways. We don't know who's going to go first, but stretch that time out to 10 years. You can certainly pay it off faster if you can, because again, it reduces that immediate cash flow need to fund the business, to fund the note. And then use an interest rate that's reasonable. You can go down as low as the AFR rate, which the IRS publishes. The AFR rate is the lowest rate that can be applied to that note without being deemed a gift. So that if you're trying, and again, it helps minimize the cash flow crunch of buying out on a note basis, whether it's a note to a third party bank, whether it's a note to the remaining shareholders, whatever it is, the terms of that note should be more generous than I usually see. So then you have key person coverage. This goes back to what I was just talking about. You have two business owners. They're both equal rainmakers to the business, and something happens to one of them. You've got the buy-sell obligation, but you've just lost one of your major revenue generators, right? And it's going to take time to find a replacement. You should have some type of insurance coverage, and this would be owned at the business level, where what it does is that forget that they're the owner, just think of them as a key person, whether they're an owner or an employee that's a major rainmaker for the business or absolutely critical to the internal functioning of the business. It's going to take time to replace them. So you buy a death benefit. It infuses liquidity in the business and buys time. Because I'm going to tell you, when that event happens, it's not just about math and numbers. It's about the loss of a friend or a partner. It's about reassuring the employees. It's about all the things, the psychological, emotional things that go in when an event like that happens. A big cash infusion, a $2.5, $3 million of cash being infused in the book buys time for the business to get through that trauma of death, disability, someone exiting unexpectedly due to death. And again, in these buy sells, where the disability portion also needs to be considered. Um, and we've got disability resources as well, but it provides liquidity to get through the event. So key person coverage, whether they owner, not an owner, employee that is a rainmaker or absolutely critical to the efficient functioning of the business, there should be key person coverage on them. And then golden handcuffs. Part of business succession is you want to retain key people. Everyone talks about it. Um, when it's hard to find key people, right? Just to find people that are competent, can do the job, believe in the business, want to stick around for the long haul. Um, Key people. Well, one of the things you can do to get them to stay is you put golden handcuffs in place. Non-qualified executive compensation. On the qualified front, obviously you want to be able to max out the qualified money for yourselves and for your key employees, but that there can be limitations. If you don't put a safe harbor in place, the amount of money that the top hat people and the owners can put away is completely contingent upon what the rank and file are doing. So, one of our recommendations are, if you have a profitable business, put the safe harbor in place. Why? Because it allows the business owners to max out their qualified plans and the key people to max out their qualified plans. It still might, well, my safe harbor match is going to cost more than I'm saving in taxes by funding it. Yeah, that's a conversation to have, but there's more utility to it than just the tax savings to the business owner. So what are there's some basic fundamental variables to non-qualified compensation. One is employer tax deductibility. Two is employer control. Three is employer cost recovery. Four is employee tax deferral. Five is ease of administration. And six is level of participation. So non-qualified executive compensation, the factors are typically mutually exclusive. The more control the business wants to have over the plan, the less upfront tax deductibility they're going to get. So more cost recovery and control means not going to be any employer tax deductions up front. It's a deferral, right? It's a deferred compensation plan for the employee. The employer tax deduction means no employer control and no employee tax deferral. There's two things with non-qualified executive compensation. One is substantial risk of forfeiture. If it's true deferred comp, the assets, the income being deferred for the employee must be subject to the creditors of the business. The other aspect is constructive receipt. Constructive receipt means control. Whoever controls it. If the employer controls it, then the employee does not have constructive receipt. You can get tax deferral, but the employer can't get a tax deduction. If the employee controls it, that's considered constructive receipt. The employer gets a full tax deduction, but has no control. Now, I'm making it very black and white. There is a spectrum of solutions where if there's blends between control and tax deductibility in the middle, between true 409A and 162 bonus. There are several points in between. It's important to identify what is most important to the employer. So one of my favorite things is every time the opening conversation, if someone's, it's their first foray into this non-qualified, well, the employer wants complete control and a total tax deduction. They're mutually exclusive, right? It's like the teeter-totter for bonds, right? As interest rates go up, price goes down and vice versa. Same thing with tax deductibility and control. It's a teeter-totter. So funding options for non-qualified. You can always have an unfunded liability sitting on the book where they say, okay, key employee person, if you do the following things 10, 15 years from now, we're going to give you X, whether it's a lump sum or a cash flow. But it's not funded. There's no asset covering it. It's an unfunded liability sitting on the books. The business can invest in muni bonds. It's tax free, but you get a very low return relative to other asset classes that you could invest in. It's the muni bonds are the only corporately owned asset, investment asset that I'm aware of that the corporation gets tax-free accumulation. And they've got to be within your home state to be completely tax-free. Investment account, the business can set up a sinking fund. They can go out and invest it, in a diversified portfolio of ETFs and have the asset sitting there. The ongoing taxation of that account accrues to the business, and if it's a pass-through entity, it accrues through to the business owner. So therefore, the business owner in a pass-through entity is subsidizing the tax deferral for the employee by paying the taxes on that account as it sits in and accumulates for some future distribution. You can buy annuities, but annuities do not enjoy tax deferral with corporate ownership, right? You can buy, the only reason a business would invest in annuities is that the annuity itself has the superior rate of return or some type of superior guarantees other than tax deferral that they can't get anywhere else. Otherwise, businesses shouldn't buy annuities. And then there's life insurance. Life insurance is the other asset class, but I don't consider it an investment class like bonds or stocks, but it is an asset class that means tax favored status with corporate ownership. So the cash values in a life insurance policy, it's funded with after-tax corporate dollars. It grows tax deferred, and it's also first in, first out accounting. Cost basis can be accessed tax-free, and future gains can be accessed tax-free via policy loans. It's self-fulfilling. So if I have an agreement in place and I have some future obligation that's worth $1 million on an employee and I'm maintaining all control and it's true deferred comp, I start funding that. I have from day one, the ability to recover everything I contributed into the plan, and two, the death benefit's going to fulfill the obligation should that employee die prematurely before the agreement reaches its end. It's self-fulfilling, it's pennies on the dollar funding from a death benefit perspective, and it's tax efficient accumulation as an asset on the corporate books. It sits there, the cash value sits there dollar for dollar as an asset on the corporate balance sheet. But it's growing tax deferred and can be accessed tax free depending on the structure of the deferred comp arrangement on the back end. So life insurance is a very efficient way to fund non-qualified deferred compensation. So this is just a grid. We can provide this grid for you if you would like to have one for your own. So on the left is true 409A deferred comp. I like to say that the IRS took non-qualified deferred comp and qualified it. 409A has got a very strict regime, a very strict set of rules that must be met for the plan to qualify as tax deferral long term and to avoid excise penalties and all types of other things. But basically, the deferral needs to be decided in the prior year. The plans that's being funded, you have to have a predetermined exit date. There is an ability to kick the can down the road by 5 years in that plan, but it's very strict. Everything's laid out up front. And it requires administration throughout the plan. Typically, you're going to use a third-party administrator of some kind to administer it, and there's a cost associated with that administration. Deferred comp with economic benefit split dollar. This is, if you're using life insurance, this allows you, it's still 409A. The cash buildup, the asset buildup is still part of the plan, and it's subject to 409A. But to give an immediate benefit to the employee, you allow the employee to name the beneficiary of the life insurance policy in excess of the employer contributions or the policy cash value, whichever is greater. And the employee must pick up the term costs, the Table 2001 mortality rates. That's safe harbor as a taxable event each year. But think about it. So let's say you have a $2 million policy and there's $200,000 of cash value. The employee can name the beneficiary of the $800,000 death benefit. they're going and if they went out to the marketplace and they paid, we're going to buy an $800,000 term policy, they would have to pay the full premium cost of that. But let's say the executive's in a 30% tax bracket. By doing this arrangement, they're getting $800,000 of term insurance for 30 cents on the dollar, because all they're doing is picking up the economic benefit and paying the tax on that, the 30% tax rate on the economic benefit. The other advantage is that in a 409A plan, the $1 million would pay to the employer, and then the employer is going to pay the benefit to the executive's family. The full $1 million would be taxable as ordinary income. Whereas if you have the economic benefit split dollar arrangement, the $800,000 will pay income tax free to the executive's family. It's a nice feature. It provides immediate financial security for that executive. They don't really have any access to the cash value, any control over that. That's the deferral. But it's a great alternative. You have loan regime split dollar. Now, this is where the executive owns the policy. The business, instead of owning the policy and paying the premiums, the executive owns the policy. They name the beneficiary. The business loans the executive the premiums. So then the cash value in the policy, the business gets a collateral assignment back for their contributions into the policy, so that at some future date, when the arrangement finalizes and the deferral component is executed, the business can recover all of the premium contributions they made. So let's say they paid in $10,000 a year for 10 years, and the cash value is worth 200,000, and in year 10 you ended the arrangement, the business gets back their $100,000, and the other $100,000 is the executives. All the gains accrued to the executive, income tax free, and the executive has always named the beneficiary, but they have a collateral assignment in place that should the executive die before it's over, a portion of the death benefit pays back to the business, and it's income tax free back to the business. It's a nice arrangement. It allows for the deferral to be finite, right? It's the loan. Now, there's a loan interest component. The business can charge the AFR rate, and the executive picks up the tax consequences of that loan interest each year. And the business could double bonus that as well to make it a zero out-of-pocket transaction for the executive. But it's a nice arrangement, something to be considered. Then we have what's called a REBA, restricted endorsement bonus arrangement. This is closer to the 162. I'm going to jump REBA and go to 162. 162 is the business is just writing a $10,000. The business goes to the executive and says, I'm going to buy a life insurance policy on you, and I'm going to pay $10,000 a year on the premium. So the business is going to pay the money directly to the insurance company. The executive is the owner and beneficiary. This is the weakest form of golden handcuffs, but there's still golden handcuffs. There's implied golden handcuffs, twofold. One is the surrender value of the policy. If you look at a life insurance policy, there's very little surrender value. $10,000 a year in the first 5 years, you might only have a $25,000 surrender value in year 5. So if the executive goes in and raids the policy prematurely, the policy's not viable. And the business owner says, if you go in and take any money out of that thing before 10 years is up, I'm just going to stop funding it. You're not going to have a viable life policy or any of the benefits that I'm trying to provide you. So there's that implied vesting, if you will, because of the surrender charges inherent in the policy. And again, the business owner can also just outright say, if you go in, you touch that policy before the 10th anniversary, I'm done funding it. You go in year 4 because you need to buy a camper or a boat, and you raid that policy, I'm done. That policy's not going to be around. It's over. So there's implied golden handcuffs. It's a good strategy. It's the cleanest, simplest strategy. There's really no administration. It's a 162 bonus. And you can arrange it so that if I'm the employer, I say, look, I only want to put $10,000 a year away on the plan. And really, 10,000 is kind of the minimum for any of these types of arrangements where the economics make sense to be looking at some type of a non-qualified executive comp arrangement. We're doing this with plans with $100,000 a year, $200,000 a year annual contributions. If you put the money into the plan, you can double bonus it. So I say I want to put 100,000 in, and I know my executives in the 30% bracket. I'm going to send $70,000 to the policy, and I'm going to send $30,000 to the executive so they can pay the tax consequences on the $70,000 contribution. So that it's truly zero net out of pocket for the executive. Or you could double bonus it. I'm putting 100 away, and I know you're going to have to pay 30 grand, and you bonus the 30 grand so that again, it remains a zero net out of pocket cost for the executive, a true benefit. So then I come back to the REBA plan. So REBA plans are, kind of it's a gentleman's agreement between the executive and the business owner. You can have a formal agreement written up. It's only as enforceable as the business owner is willing to hire a legal team. If the executive thumbs their nose at them, and again, I go back to, well, if you do this prematurely, I'm not putting any more money in it. But it also allows, the REBA document allows the employer to have eyes on the policy at the insurance company, where the executive is authorizing the business owner as a third party to the policies. So they can see what the executive's doing or not doing with the policy to honor the agreement. So some people say you can have a vesting schedule with a REBA. If you do, then it goes back to control and deductibility. The business owner can't deduct 100% of the premium if there's a vesting schedule built in place. So anyways, these are all options. We also have a great option. One of our providers has something called Select Rewards, and it's considered 409A light. It avoids all of the consequences from an administrative and structural restrictions of a true 409A plan. And it's something that we show quite a bit of. It's called Select Rewards, and it's a great alternative to true 409A, but maintains a very strong golden handcuffs. That was a pretty deep dive on those issues. Just know that if you've got an arrangement or you want to know more, feel free to give us a call. We'd be happy to go through it in greater detail. So we need to talk about 101J. So 101J basically says that if business owns insurance on an employee, they have to provide a 101J disclosure disclosing to the employee that the business owns it and that the business is the beneficiary of the policy, and the business is going to get the death benefit proceeds of that policy. So without a 101J agreement, the death benefit will not be income tax free to the business. So the reason this came about, Walmart, as part of your application process at Walmart, you would be signing a disclosure that you're going to put $50,000 of life insurance on all of their employees. And so you signed off saying you acknowledge it, but Walmart bought the policy, paid the premiums, and was beneficiary of the policy. Why? Walmart's got 1 million plus employees. It was a actuarial money-making thing for them. We have 1 million some employees. If we buy $50,000 of insurance on them, we know out of 1 million employees in any given year, actuarially, this number of people are going to die. Walmart got the death benefit. Well, people were outraged by that. And it wasn't just Walmart, but that was one of the headline companies that got beat up on this. So, well, the employee's family should get the death benefit. And Walmart said it's not what, so then the IRS says, well, if you want to maintain income tax-free death benefits for the corporation, you have to disclose to the employee before the policy's issued. It has to be done before the policy's issued. It should be done at time of application. If we're doing a business application, we're going to get the 101J signed at the same time as the application. Once the policy's issued, if the 101J is dated 1 day after the policy issue date, it's not valid. So really it just boils down to making sure that this disclosure is in place if the business is the owner and beneficiary of the policy to maintain its income tax-free benefit to the corporate or to the business entity. So that's the overall presentation. Some takeaways I'd love for you to have is one, business succession plan is absolutely critical to our clients' long-term financial security and planning. 2, business valuations are the bedrock foundation of the whole process. We have resources to help you. 3 years tax returns, we can get a free informal business valuation done within 5 to 7 business days. Then you need to have the proper buy-sell agreement put in place. If your clients have a proper buy-sell agreement, we can audit that agreement, come back with a 1-page summary as to what they have, how it's structured, and reconcile that with any of the other planning they've done, say with life insurance or disability income, to make sure it's all in place. And then when it comes to providing for key people and executives, we've got the resources to provide that planning. I hope I gave you an overview understanding so that you have the ability to identify opportunities with your clients. And my commercial is that we are here, C.O.R.E, to be your back office support and technicians to help you get it right for your clients for their reasons. Thank you so much for taking time out of your day and joining us. We look forward to hearing from you and working with you in the near future. Thank you.
Hey, Rob,
Yes.
there are a few questions in the Q&A at the top. Are you able to see that?
Give me what it's
Yep.
spinning. I don't do Q&A. No. On a cross purchase on evening premiums out per owner when premiums are 70% higher for one. Is that true on a C Corp as well? Well, again, it depends on who's owning the policy. You can balance out the economic costs by adjusting the compensation for the executives, whether it's a C Corp or whether it's an S Corp. If there's a perception that one person is being unfairly out of pocket, you can. So how I would do it, whether it's a C Corp or an S Corp. So what you do is whatever the premiums are, you have the business entity bonus the person or double bonus the person so that their net out of pocket when they pay that premium is zero. And yes, that means one person's compensation is slightly higher, but it's the corporation that's doing it, that's taking the deduction to even that out. So you do it with a double bonus arrangement and you treat it as compensation so that no one, if it is a 70% discrepancy, that younger person's getting the income to pay, to even them up with what the older person is paying. So again, for me, you just do a double bonus compensation arrangement to even out the field. Is your free valuation the same as the one principal? Is exactly the same. No, we use Principal. That is the resource that we use. Now, we have other companies that also do them. We could theoretically submit it. We have two other resources that provide very similar standards. So we're not going to take one case and hit up two companies for the support. It's not something that we do in our value proposition to our vendor partners. We don't. I have issues with going and say, okay, I'm going to go to X company and have them do it, and I'm going to go to Y company, have them do it, go to Z company and have them do it. No, the whole time when it comes back, I'm going to Y. We just don't do that. But we have other resources on the Principal. I just will say Principal has got the best turnkey overall solution package from A to Z when it comes to this type of planning. And the most critical part on the back end is the administration. The administration, like 2 years, 3 years, 4 years into these arrangements, it's the administration that's absolutely critical for the long-term success. Principal's got one of the best administration systems in the business. Can you all run a spreadsheet doing this? I'm not sure I understand, Henry, what that question means. Will we spreadsheet the solutions, like the different carriers and the different products? We always do that. We never come in, we're going to map out all the products and solutions. But I don't know exactly what that means. So those were the three questions. Again, I want to thank everybody for participating. Henry, if you have additional questions, feel free to give me a call or give your relationship manager a call. We'd be happy to dig a little deeper into the questions. Thank you so much, everybody. Have a great day.